At this level, that's all you really need to see. To me, that's all that is relevant. No one stood for delivery. Less than 1% of contracts stood for delivery. A contagion, a systemic failure that blows up not just one bank, but a whole series of banks, or between here and 700. Wouldn't surprise me. If you said $200, is that really that crazy? I mean, I think, Michelle, all you need to see is the amount of deliveries coming on the COMEX, and I can make it very simple. When I started talking with you about this stuff several years ago, it was about the central banks purchasing gold and the repatriation from the Bank of England and the New York Fed. But now it's progressed to massive deliveries coming on to the COMEX market. Entities standing for delivery for billions and billions and billions and billions every single month for going on 16 months. At this level, that's all you really need to see. To me, that's all that is relevant. The people who are standing for delivery for literally in December, as an example, the largest delivery of silver in the history of the COMEX market in the month of December, somewhere in the neighborhood of 68 million ounces of silver. Who's standing for delivery for 68 million ounces of silver? Every month, 3, 4, 5 million ounces of gold or more. This is going on repetitively, and there is no one talking about it. To me, there's nothing else you need to see. So these pullbacks that we see, like we saw this morning, are, to me, not anything other than a gift. Now, it's hard for someone to really, look, short-term caution, sure, anything that's gone up this fast. Long-term bullishness, absolutely, they can coexist together. But I think that when you look at a market like this and see the deliveries, see the rate hikes in margin that do nothing but knock it down for a day or two, shaking the weak hands off.
This is the smoking gun. For decades, the COMEX operated as a paper casino where contracts were cash settled, not physically delivered. Schectman's 36-year career saw less than 1% delivery rates. Now, for 16 straight months, billions in physical metal are being demanded. December's 68 million ounces of silver alone represents more metal than some countries' entire annual production. Who has this kind of capital? Who's sophisticated enough to bypass paper manipulation? Not retail investors, they're still oblivious. This is sovereign wealth funds, central banks, and strategic entities who know something the public doesn't. They're voting with billions. Paper is worthless, physical is everything.
A position of rising margin responsibility and the selling that incurs as a result of it, but it always used to. When that happened, it would just fall and fall and fall and wouldn't come back. And now all of a sudden, it's like a speed bump and it comes right back. So to me, you don't need to see much else than to see the demand that is coming at the very highest level here in the United States.
So help us understand what standing for delivery means and how these contracts are usually resolved. I mean, people sometimes just pocket the trade in terms of the paper silver. Help us understand what that means to actually now say, no, actually, we want the physical silver with the futures contract, or the physical gold for that matter as well. And how does this compare sort of percentage-wise in terms of how often people actually stand for physical delivery?
Well, most of my career, which is almost 36 years long, no one stood for delivery. Less than 1% of contracts stood for delivery. And that
less than 1%?
Less than 1%. And that is what I've been screaming about for the last several years. And, it started with a group that the COMEX calls the others. Now, they publish a report every week called the Commitment of Traders, which would show the positioning of the largest traders. And it was always just two subcategories: the commercials, JP, Goldman, Citi, the specs, the hedge funds, and one would go long, one would go short. And around 2021, we saw a third group of reportables that was added to this weekly listing of the biggest traders, and they called it the others. And they're still there. We believe them to be sovereign wealth funds in particular. But I started talking about in so many of my videos that something's going on here because big money is now standing for delivery. Now, I don't know the exact percent of it, but I will tell you is that the amount of deliveries that we've seen in the past 15, 16 months here in COMEX, on COMEX, is akin to 4 feet of snow in Death Valley in July. And I guarantee you they're not going to open up snowmobile dealerships if that were to happen in Death Valley. It's an anomaly in every respect of the word. And what does it mean to stand for delivery? That means instead of being cash settled for your contract, or rolling it over for another month in the future, they are saying, no, we want the metal right now. And it's delivered into the COMEX ecosystem. A lot of it leaves COMEX, goodbye, and never comes back. Where is it going? We don't know. Is it going to China? Is it going to the Treasury via the Exchange Stabilization Fund? Who's taking it? Is it Tesla? Is it Samsung? Is it Sony? Who's doing it? Now, a lot of it stays in the COMEX, and there are two categories of holdings inside the COMEX. Miles Franklin has 8 Brinks facilities within its storage program. One is in New York City. That is JFK. That is a COMEX facility. I have clients that have a large amount of silver in 1,000-ounce bars in their account, and that's called eligible. Now, eligible means it is eligible to be sold, but it is not for sale, and my clients aren't going to put it into the COMEX anytime soon. Registered, on the other hand, means those bars that are backing the contracts that could stand for delivery. So what isn't leaving the COMEX goes into safekeeping ineligible inside of a Brinks vault or any of the other COMEX facilities where it's not for sale and it's just being held there for safekeeping. Because again, when you think about 68 million ounces,
Schectman's Snow and Death Valley analogy perfectly captures this moment. The COMEX wasn't designed for physical delivery, it was designed to suppress price through infinite paper contract creation. When the Commitment of Traders report added the others category in 2021, sophisticated observers knew something monumental was shifting. These aren't hedge funds speculating, they're strategic entities accumulating hard assets. When metal leaves COMEX vaults permanently, it's not coming back. Is China draining Western vaults? Is the Treasury's Exchange Stabilization Fund secretly stockpiling? We don't know definitively, but the magnitude is undeniable. The fractional reserve scheme that kept gold and silver prices suppressed for decades is collapsing under physical demand.
Fine line between conspiracy and reality, but where is journalistic integrity? Why is it that we have to talk about this all the time and no one is saying who's standing for delivery for billions and billions?
Who is standing for delivery? I know I'm asking you to speculate here, but what are some of your theories on this?
I mean, part of me feels like it's the Exchange Stabilization Fund, like it's the U.S. Treasury. I mean, so far in January, which is not a delivery month, I don't know, somewhere around 40 million ounces has already been delivered. I haven't checked it, but I would assume that's about where it is. It was in the upper 20s last week. So even if you take the upper 20s and you add it to the 64, 5, 6 million ounces that was delivered in December, the largest ever, you're at roughly 100 million ounces in the last 45, 50 days that have been delivered. Now, is there any, I think, coincidence maybe that the government classified silver a critical mineral and they just passed a law saying that the government will put price floors underneath critical minerals within the next 90 days? I think that there is this fine line between, could it be Samsung, Sony? Could it be the government not telling us? If it's done under the Exchange Stabilization Fund, they don't need to get congressional approval. They don't need to tell Congress up front because it's for national security. Well, silver has now been made a priority for national security.
The Exchange Stabilization Fund operates in the shadow, sits the Treasury's Black Ops budget for currency and economic warfare. Created in 1934, the ESF can intervene in markets without congressional oversight if national security is invoked. Now that silver is classified as a critical mineral with forthcoming price floors, the ESF has legal cover to stockpile aggressively. This isn't speculation, it's strategic necessity. Advanced weapons systems, AI infrastructure, 5G networks, and electronic warfare all require silver. If foreign adversaries are stockpiling and the US maintains inadequate reserves, it's a national security failure. The convergence of policy critical mineral status and action record deliveries suggests government involvement at the highest levels.
This is not a mania. It's not a mania because even though we're doing tremendous volume in business, it's not the volume that we saw during Silver Squeeze, where everyone was buying little bits, even a couple $1,000s worth, where the public was starting to expand. Now, these are the people who we've worked with for a long time, or the people who have been watching you for a long time, or me or others, who are finally saying, it's time to actually do something meaningful here. And we're seeing much larger orders. Our average order size right now is exponentially larger than it's ever been. These are people who are concerned, who are aware, and are seeing the same things that we're talking about, but they represent a tiny portion of the public. The public is still vastly unaware of this, and that's due to the fact that how do you explain that we have gold and silver at all-time highs and it's nowhere to be found on the mainstream
This
media.
distinction between mania and structural shift is crucial. During the 2021 Wall Street Bet silver squeeze, Miles Franklin was overwhelmed with thousands of small retail orders, $500 to $1,000 purchases from first-time buyers chasing a squeeze. That's mania, uninformed masses FOMOing into an asset. Today's dynamic is inverted, exponentially larger orders from sophisticated investors who've studied for years and are now deploying serious capital based on fundamental analysis. Retail remains absent. Your neighbor, coworker, and family members have no idea gold hit for $1,940. When CNBC runs 24/7 gold coverage, and your Uber driver asks about silver, then worry about bubbles. We're nowhere close to that.
Thing is a coincidence at that level? I don't think so. And most of the media attention that you speak to frames it as it's reached its peak, it's topped, it's overbought. A lot of the things that I would argue, if there was really informed journalism, these things that are valid perhaps in a market that is freely traded, but a market like gold and silver, which has never been allowed to find real price discovery. And I think that's undebatable. I mean, that just isn't debatable that metals market have been suppressed for various reasons. We don't need to go down that road again. We've talked about it ad nauseum. But how valid is technical analysis in a market that has never been allowed to find price discovery? In a market where the West has controlled the paper price forever, but that's breaking. And it's breaking because of the standing of delivery, whether
The timing alignment between Trump's inauguration and accelerating physical deliveries is too precise to dismiss. Whether through executive orders, ESF activation, tariff threats forcing strategic stockpiling, or simply policy certainty enabling large capital deployment, something shifted in January 2025. Mainstream media calling markets overbought reveals their ignorance. You can't apply technical analysis frameworks designed for free markets to assets that were systematically manipulated for decades. When JP Morgan paid $920 million in 2020 to settle charges of precious metals market manipulation, it confirmed what gold bugs knew for years. Now the suppression mechanisms concentrated shorts, paper contract flooding, dare failing under physical demand. This isn't a top, it's breakout from a 50-year cage.
normally when you have a discrepancy like that, Michelle, arbitrage resolves it, right? But it's not resolving it because the Chinese say, thank you. We'll pay more for your metal if you have the ability to buy it here in the Western paper and deliver it in physical in Shanghai. Thank you so much. And it's just that sucking sound that you hear is them really, I guess, trying to tempt and tempt the traders to deliver metal to China for a premium, for a profit. And the fact that it hasn't corrected and it continues to say persistent says that this is their plan. They're doing this purposely. They're doing it to incentivize anyone who wants to make that big profit, where you can buy it. You take 5 million ounces, you buy it here, and you deliver it there at $10 an ounce. Well, you just made $50 million. Easy peasy, and the traders are happy. So are the Chinese with the trade imbalance that they have and shedding the dollars, de-dollarization. They don't care that they're paying a premium. They've been mining gold and silver in their own country for years. That was uneconomical because they see the big picture. And geez, look how economical it is becoming now. No, I think that they see a big picture and we don't. And so the traders who are doing this are short-sighted. That metal won't come back. It is being reintegrated into the economy, that being gold and silver. It is critical. And we've known that for a long time. And I guess it's just becoming recognized. Everyone talks about the United States making silver critical. They talk about China restricting exports. They don't talk about two other things that are important. And that a year before that, the European Union designated silver critical. And 2 months before China said we're going to limit exports by permitting all of the very large refineries who would have the ability to do this, they said, we're the second largest producer of silver in the world, and our silver domestic production will be kept for domestic priorities.
The persistent arbitrage premium in China isn't a market inefficiency, it's strategic policy. By maintaining prices $8.10 above Western markets, China creates profit incentives for traders to drain COMEX vaults and deliver metal to Shanghai. China doesn't care about paying premiums. They care about accumulating hard assets while shedding dollar reserves. The mining economics reveal Beijing's long game, producing silver at a loss for years because they understood its strategic value before markets repriced it. When Schectman asks why 8 Western banks held the largest concentrated short position of any commodity in COMEX history, the answer is uncomfortable. silver's price was suppressed to hide its true importance. Advanced militaries, AI data centers, EVs solar require silver, allowing prices to reflect supply-demand reality risk strategic panic.
Something far more important about silver than its price would be allowed to explain. And it's disappearing in nature, and it's vital in a advanced civilization, whether that be advanced military equipment or AI or technology, digital, electronic, etc. And that's now being exposed through delivery. You can't paper something over when everyone says fine, but these contracts say we can deliver. Where's my silver? Then we have a very, very, very big problem. And that is, to me, what is happening. And if the Economic Times is right, following Tom Luongo's thesis, which I find to be quite intriguing, the US banks are net long. Who's left holding the bag? The European banks in Canada. Tom believes that Trump is very upset about the European aristocrats. He believes, right or wrong, that they were involved in election interference. Now, Trump just said in Davos yesterday that there was election interference, and there is, and there was, and it's proof, and people are going to get indicted over this. I probably shouldn't have said that, he says. There's breaking news. Well, he believes someone was involved with it. Tom Luongo thinks that he believes it was the European aristocrats that stand behind the big European banks.
This is the geopolitical revenge trade hypothesis. If accurate, it represents financial warfare at the highest level. The setup: European banks Deutsche Bank, HSBC, Scotia, held massive concentrated silver shorts for decades, possibly with U.S. bank cooperation. Tom Luongo's theory suggests Trump believes European elites interfered in U.S. elections and is retaliating economically by encouraging physical delivery and forcing a short squeeze while U.S. banks quietly flip long. European banks face existential catastrophe. A short squeeze to $200 for $100 silver doesn't just bankrupt individual institutions, it triggers systemic contagion across European banking. The U.S. emerges with long positions profiting from the chaos while geopolitical adversaries face financial ruin. This isn't confirmed, but the timing, policy shifts, and unprecedented delivery volumes fit the thesis uncomfortably well.
I think we're moving away from globalism. I really do. And I think gold is continuing to reprice itself on reserve demand and policy uncertainty. I think gold will be reintegrated into the monetary system. And I think in essence, what she's really hedging at is that a system that is built upon trust, that moral high ground that we stood upon, after World War II, I think has been trampled. People probably don't trust us anymore. And so when there is no gold behind it, yeah, it is a system that is, I think, inherently dying.
When the president of the European Commission uses a World Economic Forum keynote to invoke the Nixon shock moment that ended gold-backed money, it's not academic history. It's a declaration of intent. Ursula von der Leyen is telegraphing Europe's plan: reduce dollar dependency, build European monetary independence, and prepare for a post-dollar world order. The fact that this message was delivered at Davos, the annual gathering of global elites, signals coordination. European leadership isn't speculating about whether the dollar-centric system will end, they're preparing for its end. The parallels to 1971 are deliberate. Back then, Nixon unilaterally destroyed the gold standard. Today, structural forces, debt, distrust, alternatives, are destroying dollar hegemony. Europe is positioning to survive the transition.
Right now, because of a lack of trust. And that's really what it's come down to. In fact, it's interesting because Van Eck came out just the other day, the mutual fund company, and their bond team, it was was built by, or a report written by their emerging markets bond team. I just want to read this to you real quick. I've argued for a while, Michelle, that we are moving to more of a mercantile situation where countries will take care of their own ecosystem. And whether it be looking at Enbridge, which is now operational, as is the unit, and they're trading on it, along with the SIPS, cross interbank payment system, which we talked about how they had signed up the countries from Southeast Asia, the ASEAN acronym countries that represent 800,000 people, twice the population of the US, 35% of global GDP, China's biggest trading partner by far. They're using these rails now, which chips away from the settlement status of the dollar and using gold to replace the reserve status.
The Enbridge activation represents the operational de-dollarization infrastructure finally going live. For years, BRICS nations discussed alternatives to SWIFT. Now they exist and function. ASEAN's integration is particularly devastating. Indonesia, Thailand, Vietnam, Philippines, Malaysia, and Singapore represent 800 million people and 30% of global GDP. All their trade formerly required dollars for settlement, creating artificial demand that supported dollar strength. Now, through M-Bridge and CIPS, they settle bilaterally or in gold, bypassing dollars entirely. This isn't theory, it's happening transaction by transaction. Each trade settled outside the dollar system permanently reduces dollar demand. When countries no longer need dollars for trade, they don't need treasury bonds for reserves. The support structure for American debt markets is evaporating in real time.